This is the Future of Finance.
This episode is brought to you by Metis Global Partners. Hey everyone, welcome to the Future of Finance podcast. I'm George Dyer, and today we have Rick Alexander on the show. Rick is the CEO of the Shareholder Commons, which focuses on what they call system stewardship. And the idea is that for investors, especially for diversified universal owners, if individual companies are maximizing their own profits in ways that create externalities that destroy value in other parts of the economy, then the investors' overall returns will be hurt much more than the returns from any one company might be increased. It's kind of a clear and obvious way of thinking about the inherent vested interest that all investors have, and really all of us have, in creating sustainable and regenerative business models that don't externalize those costs to other parts of the world or other parts of the economy or to the future. But it's also just a really big mental shift for many of us, particularly for investors and business leaders, where this idea of profit maximization at all costs has been so core, such a core concept for so long. So Rick's been really one of the leading thinkers on this, and his work at the Shareholder Commons has been instrumental in sort of articulating this whole case and helping investors see how they can put it into action and what steps they can take to protect their portfolios and their long-term returns. He has a really strong background in corporate law that gives him a lot of insight and credibility on all these topics. So I hope you enjoy it. Please take a minute to let me know what you think. Leave a comment or a review on Apple, Spotify, or YouTube. And please do follow or subscribe. It really helps. So thank you for listening. And now here's my conversation with Rick. Hey, Rick, how you doing? Welcome to the podcast.
It's great to talk to you.
Yeah, thanks so much for being here. I'm really excited to share your work at the Shareholder Commons with our network and our audience, and kind of dive into some of those details. But first, tell us a little bit about how you got there and how you started Shareholder Commons in 2019, but you were a lawyer for many years. You were head of legal policy at B Lab before that. So just tell us kind of how you got to where you are.
Sure. Thanks for having me, and thanks for everybody for listening. And it's been like a journey, and I'll say a little bit of my personal journey kind of tracks thinking about this particular issue we're going to talk about today, because I spent first 25 plus years of my career, as you said, as a corporate lawyer in Delaware, doing mergers and acquisitions and fundraising, preferred stock, IPOs, all that kind of thing. And all of that was based on the idea that you have corporations that are run by directors who are elected by shareholders. And the duty of the corporation, really in large part, is to optimize returns, financial returns to those shareholders. Now, there's some schools of thought that sort of vary from that, but honestly, the judges, the lawyers, everybody who works within that Delaware system thinks of it pretty much that way, and that's how it works. Personally, I was somewhat of to the liberal side of things, and I care about things like the climate and inequality. But I thought that was okay that companies tried to make as much money as possible, because the economic theory is they're taking inputs that they get at a low value and sell them at a high value. That means they've created value, and it's the job of government to make sure that they're not externalizing social and environmental costs. So right. It all kind of works out. I think at some point, though, you have to look at the world and say, well, is that working? I started to sort of think that way. And in particular, we had been approached to Delaware Bar by the folks at B Lab. They do the B Corporation certification. And part of what they wanted to do was have a different corporate form that didn't have the maximization of shareholder value as the core idea. And their thinking was they had designed a whole system to measure and manage the social and environmental impact of for-profit companies. But it was, and they had companies who wanted to input that, but it was hard for them, because if those companies scaled and they took in money from the public markets or from private equity, they'd feel this pressure to no longer go along with the B certification provisions. And so part of their certification model was finding ways to have their B Corps, their certified B Corps, be in a corporate form that didn't always maximize value. And they designed this thing called the Benefit Corporation, and they wanted to bring that to Delaware.
Mm-hmm.
And so I got involved with them, and I was very skeptical at first, but eventually I came around.
Mm-hmm.
And I got so interested in that movement that I went to work for B-Lab. And part of, in addition to the certification work that they did, part of their mission was just publicizing this corporate forum around the world, and we help different countries and different states within the United States and different provinces within Canada adopt this forum.
Mm-hmm.
British Columbia, Italy, lots of states within the U.S. Adopted this forum. And that was very interesting to me as a lawyer to sort of push that idea and use corporate law as a way to make the world a better place.
Mm-hmm.
But, and this now gets to the work I do now, one thing I found at B-Lab was that we still had the same problem. Even if companies took on this corporate form and used the B-Lab certification model, when they took in investor money, they inevitably felt this pressure.
Mm-hmm.
And the classic example of this was Etsy, which was like a leading, B Corp. And after they went public, their stock didn't do so well, and a hedge fund came in and pushed for a change in management, and they gave up the whole B Corp idea.
Mm-hmm.
And I mean, nobody did anything wrong in that case. It's just the way the public markets work. They're focused on shareholder value.
Yeah.
And so we started thinking internally at B-Lab, what do we do about this? Like, what's the way to convince investors
Mm-hmm.
that it's in their interest that companies have a more sustainable business model?
Yeah. Well, I'm excited to get into it. We do a whole nother podcast on B-Lab and benefit corporations, and I would love to, because I think it's so interesting whether, like where the law is really a limitation and where it's business culture, corporate culture, investor culture around some of these ideas. Anyways, don't want to go too off on that tangent, but I think it's fascinating work. And so that kind of corporate law work brought you to see how investors, the kind of role that investors play in all of this. You say the Shareholder Commons addresses the divergence that often emerges between companies' interest in maximizing its cash flows and its investors' interest in optimizing overall market returns. So explain that kind of basic idea and where that tension comes in.
Yeah. So as we were doing this work to sort of try to figure out how to square the circle of having responsible companies but not having investors push them, to put profits first, we came across this literature called universal ownership that had originated in the 90s. And then there was a book called Fiduciary Capitalism by Jim Hawley and others, written in 2000, and some more work done in the aughts around this idea that as capitalism had developed over the 20th century, it had come to be that most owners weren't like individuals or families, but were big institutions like pension funds or, in case of your organization, endowments, just big mutual funds. And so the owners, and there had been this development in the 20th century that as an investor, the best thing you could do was diversify your portfolio, because then you could buy lots of risky securities, which have higher returns, but get rid of the idiosyncratic risk of being overexposed to like a single company or a single factor or a single industry.
Mm-hmm.
So most of these big institutions are diversified. So a pension fund, it's written right into the law. They have a fiduciary duty to diversify. And what universal ownership theory tells us is that it's very important to focus not on individual companies outperforming, but how the whole market performs. Because as a diversified owner, actually, this was in Matt Levine's column. Lots of people read Matt Levine's column in Bloomberg, and he talked about this yesterday. For these diversified investors, what really matters is the movement of the whole market, because they essentially, those investors, own a slice of the economy.
Mm-hmm.
So if one company in your portfolio is outperforming by saving money and increasing its margins by polluting or by ignoring violations of human rights in its supply chain, it might deliver more profit. but it's also externalizing the costs of pollution and climate change and inequality and social disruption to the economy, and the rest of your portfolio is likely to suffer. And so this is the key to understanding that investors are not necessarily financially served when each individual company in their portfolio tries to maximize value, because they're measuring value at the company level rather than at the portfolio level. And so what we try to do at Shareholder Commons is operationalize that idea.
Yeah. Well, it's so interesting. I mean, let's talk more about the externalities piece, because it seems like it kind of all centers around that. In my understanding, it's funny. I remember like taking environmental economics in college and learning about externalities and what a big impact they had, and just thinking like, oh, there's got to be more issues, more factors. And then like the longer you go in this, it seems to just always come back to externalities and sort of the rules of the road not being correct and allowing companies to push out these external costs to the broader public or the broader market. And that's what I think is so interesting about investors, because they have this sort of inherent self-interest, as you just described, if they're universal owners, to address that. So yeah, I mean, talk about what that looks like, how they can do that.
So, and I said earlier, like at the beginning of my career, I was like, well, that's the government's job. And
yeah,
the thing is, like in a perfect world or with a perfect government,
they would be a governance
externalities. They would say, well, we're just going to mandate that everybody is paying a fair wage up and down their supply chain, and they're not releasing toxins into the environment. But that doesn't happen. And interestingly, it doesn't happen in part because we've charged these very powerful institutions we call corporations with the job of maximizing value. And one of the ways they do
at all costs, like any,
and to avoid or to hop to a jurisdiction that doesn't see such a good job with these externalities. And so what you're left with is, I'll just go back a second and say, the theory of our economy and having companies maximize value is that it just goes back to sort of this idea that, Adam Smith and Mandeville talked about, is that like, well, they're just, even though they're trying to serve themselves, they end up creating public good by creating all this value.
Mm-hmm.
And so we actually use the value maximization idea to allocate resources in our economy. That's how we decide what to produce. That's how we decide what services to provide and how to make them. And the problem is, again, from this broad economic perspective, that we're misallocating resources. Mm-hmm. And so what investors can do if the government isn't putting in the right regulations is they can use their power. Now I'm getting back to your question. They can use their powers as investors to try to do a better job allocating. So one very simple way to do this is to engage with the companies they own. Mm-hmm. So if they own a company, let's say they own a steel company, and the company is using the older, more, carbon intensive methods, shareholders can because that's, from their perspective, that's going to create the widest margins and the most profits and the most dividends, share value. Shareholders can communicate to the company, we don't want you to do that. It might seem like we'd want you to do that because it'll make your stock price higher, but we actually own the whole market, and we want steel companies to move toward more less carbon intensive methods of production. Mm-hmm. So you can simply engage. And when things like that come up in shareholder proposals, you can vote that way. So just very much you can use your powers as an investor in a company to try to get the company to act in a way that's more cognizant of the externality issue. And obviously you can also direct your capital toward
the companies that are doing a better job at that. Yeah. What about, let's talk a little bit about that though, because I think a lot of people's sort of heads would just explode and try to like wrap around their idea, like their heads around this idea that an investor would go to a company and say, we want you to take this practice that's going to be less profitable, at least in the short term, because it's going to help our overall returns for the economy. And it's true. Like you say, like these companies are owned by investors. They are the owners. And so they should have this sort of power or influence to kind of make that decision and take that broader systemic view. But I guess one other area of potential conflict is like I would imagine, board members of these companies or other just investors that are not universal owners that might be highly concentrated in this company or whatever would have a different view on that.
Yeah, and I think that's an issue, the conflict issue, and there's conflicts kind of across the system, and that's one of the things we need to focus on. And I remember back when I was a practicing lawyer, we would always look for the conflicts and try to deal with them. We'd always say, well, and people would get like really they get their back up if we said there was a conflict of interest, and we'd say, well, look, a conflict of interest isn't a crime; it's a state of affairs. And you need to figure out, well, the conflict means maybe a decision maker is an objective, and that's not like, they're not bad. They just happen to have this other interest. And so we need to figure out a way to deal with that to make sure the best decision is being made. And so what's interesting is, let me give a little history here too, because I think the contrast is important. Originally you had like movements for investors to sort of, be good. And people just thought, well, let's do that. And let's back in the 60s, like telling Greyhound bus to not segregate their buses. And then you had obviously the apartheid move, the divestment movement, with respect to apartheid in South Africa. And at that point, I think investors were just, let's do the right thing and not make money off of apartheid. And then somebody said, or many people said, wait a second, a lot of these investors are fiduciaries, and it's nice that they want to care about those issues, but they have to worry about making sure they can satisfy their pension obligations, for example. Mm-hmm. So people started thinking about this as ESG. And again, I'm shorthanding, but the idea that, well, if companies are more responsible, they'll make more money. And that's today, a lot of when investors try to act responsibly with respect to the environment or social issues, they'll go to the company and they'll argue on this ground. They'll say, well, if you are more open to more diverse workforce, you're going to make more money. And here's the study that shows
you'll attract better talent. Your company will do better. Yeah.
Yeah. And you need
those types of things,
climate regulation, all that. Mm-hmm. And so that's what people feel comfortable with. And this was sort of your point, but people don't feel comfortable going to the company and saying, hey, I want you to make less money because it'll be good for my portfolio. But what I always want to emphasize, and I have a slide where I show a picture of Superman. I say, this is actually, like, you're shy about this, but this is actually your superpower as an investor. Because if you go in there and argue with, the CEO and the C-suite and about how to make money, those people are very good at making money. They get up,
it's their full-time job.
How to make more money.
Mm-hmm.
But they don't think about these other issues. They're not charged with that. So if you can go in there and say, look, I understand that you're, using this technique or not electrifying quickly because it'll make more money, but I don't want you to do that. And don't worry about it. I'm going to support you, even though the margins fall. That's a conversation that people aren't used to having. But like, once you have and say, I'm not attacking you. I'm not saying you're doing the wrong thing. I am saying, this is how I want you to run my capital. And if we can change the culture, so people are comfortable with that and understand, I know the CEO has a lot of options and we want you to maximize value. I'm glad you're doing that, but I want you to do it within, we call it the Shareholder Commons guardrails. I want you to do it within these guardrails that protect the common goods, the environment. Half of the GDP, people say, is based on eco services. So if we are destroying the environment, we're putting half of our GDP at risk. And I don't want you to do that, because that's the worst thing for my portfolio.
Right. Yeah. It's, I think, you call it system stewardship, this type of engagement that like kind of takes the whole system into perspective. And I think that is where so much of the power is. I think it's so much at the core of sustainability and everything. And why we have this disconnect a lot of times is because people, are just focused on their discipline or their company or their just immediate area and don't have that appreciation for the implications of how it impacts the whole system over time and space. And so I mean, talk, I guess, a little bit about system stewardship that you already have. Like, it's just this different way of engaging with companies, having this different conversation that's this, not the same as the ESG or sustainable investing conversations.
Yeah, exactly. I think you put it in the nutshell there, which is the idea that as an investor, it is very important to you to protect not just individual companies, but all these like complex global systems that those companies are embedded in. And that can be a climate system, it can be, biodiversity, it can be the rule of law. All those things make all companies more valuable, but they're fragile systems that can be put at risk by economic activity. And so the idea of system stewardship is that you can use the tools that you have as an investor, and that can be like individually as an investor. And one important thing to say is, lots of investors rely on asset managers
Right.
to manage their portfolios and think about how they vote.
Mhm.
And you can ask your asset manager to, one way of doing this work as an asset owner is to make sure that your asset manager is on board with using these tools to manage and protect the systems. And just terminology, we've been using this term system stewardship.
Mm-hmm.
And there's been like a sort of evolution to that. And I'm seeing now people are going toward an even the next term, which is system level investing. And I think you've had Bill Burkhart on this
Yep.
program before, and his organization TIP uses that term.
Mhm.
And it suggests, sometimes people hear stewardship and they think, well, that just means kind of doing the work with the companies you own, but system level investing takes it to the next level and says, and also make sure you're directing your capital in the right direction. And I'll give one very specific example because we've talked about voting and engaging.
Mhm.
Ellen Quigley at Cambridge in the UK has done a lot of work on bond indexes.
Yeah.
And she, together with Bloomberg, are now putting together a bond index that will allow you to get a diversified, like broad index of exposure to the bond market, but exclude any company that's investing in new fossil fuel infrastructure, because there's a lot of work showing that that's one of the worst things we can do around climate is to lock in economically long-term interest in continuing to use fossil fuels over renewables.
Mhm.
And so, once that becomes available, you'll be able to direct your capital in a way that preserves the system, because by denying debt to these projects, you make them more expensive.
Yeah. So we'll talk a little bit more about some of the main issues that are these sort of like systemic issues. I mean, we've talked about climate, extreme inequality is another one that often comes up in the system level conversations. What are some of the others?
And this is an important issue to talk about, because you don't, there's always the risk that you're like, well, I don't like it when human rights are abused, so I'm going to say it's bad for the economy. And, there's always, to me, the little bit of the fear that, I don't know, maybe by treating people really badly, some companies, or even, maybe they're not touched by stock. And if you, think about the world, the people who live on, $2 a day or less, like, you can continue to ignore their rights. And so we want to make sure, if we want to be credible, with respect to this as a way to maximize value, that we're drawing a good connection between the systems issues and these other issues. And I think there is a lot of work that would suggest, no, in fact, inequality, for example, is actually very bad for the economy long term. Because if you're leaving a billion people behind, then they're not going to, develop. I don't like the term sometimes human capital, people capital, but they're won't be able to make as valuable a contribution to the economy.
Yeah, there's a lot of talent, innovation, et cetera.
So and there's lots of work that you can the idea that, the Gini coefficient, this one measure of inequality, every time it goes up by 1%, GDP goes down by 1%. It's a very rough justice, but something like that. Lots of work on climate showing that over the long term, the economy is really going to hurt. Like there's some work that specifically says portfolios will suffer 30 to 40%, decrement in long-term return if we stay on the current track rather than getting to a Paris-aligned economy. But that same kind of work has been done around, like, for example, antimicrobial resistance. The idea that, right now we have a suite of antimicrobial, medicines that address, bacteria and fungi and things like that. And that the more of those you use, the more ineffective they become. People are familiar with that idea.
Yeah. You start pumping them into animals so they grow faster and stuff. You get these super bugs that, evolve to be resistant.
Yeah. And the UK Treasury a few years ago did a study that showed between now and 2050, again, if we stay on the current trajectory, the global GDP will suffer by $100 trillion. And that will matter to investors. I mean,
this is just for antimicrobial resistance.
Yeah, because
the health impacts primarily, like just the disruption to health systems.
So, like, I actually think it probably understates things because it's direct medical impacts and like people being sick and having, but also, if we don't do anything, like in 2050, like routine surgeries, like getting your knee replaced, will be dangerous.
Yeah,
because like hospital-borne infections will be so prevalent, and that would just really cut back. It'll be secondary effects too, and so and lost work time and all those things.
Yeah, jeez.
And I think there are like many places where that type of work can be done. Another one I like to talk about, where there is, I think, work being done on a universal owner basis, is the mining industry, and in particular, the tailings problem. People are probably familiar with. Over the last decade, there have been terrible tragedies, especially in Brazil, where, mining companies just sort of take out the what's left over after they've pulled out the ore, and like maybe 1% of it or less is actually the mineral they need. And they have these huge piles that they call dams, that are dangerous. And when they collapse, it can be like a dam collapsing, and hundreds of people have died in some of these tragedies. And investors have come together and said, we need to have expectations of companies that they're going to do something about this. And again, I think people say, well, why should a company spend money on this? It's like low risk. And
it's like a localized event and stuff. How does that affect the whole economy?
And I think what is the problem is that we cannot transition to a low carbon economy without a vibrant mining industry. And these kinds of safety precautions are necessary to preserve the industry's license to operate. Because at some point, countries are going to say, no, Vale, you can't come in here and make another mine.
Yeah, we've seen what you've done.
You kill people. And that's, that's going to be a problem. So I think, and I will say that there's actually an organization that is now dedicated to raising money to fund academics who are making connections between big systemic issues that companies contribute to and portfolio, like diversified portfolio value.
Yeah, this is the Externalities Research Network.
Yes.
Yeah, excited for that work. And like I said, I think that it's core to so much of these conversations. And I think it just helps, if we can get some of that culture shift going, I think it helps companies and governments and everybody see, like, I see it as sort of an evolution of like this, everyone acting in their own self-interest benefits the whole, to say like, yes, but it needs to be sort of this enlightened self-interest where you're looking at the whole system and not just this narrow slice, because we're just operating at a scale on one planet now that's necessary.
Yeah, I always say like the idea that if we all go in our own self-interest, it'll create value is, Adam Smith called it the invisible handle. And he used that phrase once, not not as many times as people think he did. But then it's, been turned into this complicated formula with lots of Greek letters, the first fundamental theorem of welfare economy or something like that.
Right.
But if you look at that theorem, it's got all these assumptions built in. Like one of them is no externalities. And so we're just kind of doing it wrong.
Yeah.
But we are sort of going beyond that problem. We're trapped in what I say is a prisoner's dilemma, because each individual company and the people who work at that company and somebody who's overweighted, an investor who's overweighted in that company, can benefit from that company doing the wrong thing, even in a world where everybody else did the right thing. And so you sort of end up with this, problem where the equilibrium is everybody's going to just act in their own interest because I have options or I have fiduciary duties. And I know I'll always do better, whether the world does better or not, if I, breach.
Yeah. It's like a tragedy of the commons dynamic.
Exactly.
Yeah.
And so fixing that is really hard. And, Eleanor Ostrom did lots of work about how you do that. And for us, and this is kind of something we think that, like, we spent 5 years and we and lots of other people working on this problem have, I think, done a good job raising awareness. And now I think what we have to do is say, okay, people are aware of this, but that doesn't solve the prisoner's dilemma problem. We have to build a culture of trust in the investing community, in the business community, so that people can say, I'm not going to push for that last, nickel of margin if it means I'm damaging the broader economy. And people can trust that everyone's going to do that. And I think every solution is downstream of a culture.
Yeah, I couldn't agree more. And how are you thinking about doing that? Because obviously that's not easy to do.
So what has happened in the last 18 months is there's been a little bit of an explosion of people talking about system stewardship, and things like within the last 2 months, I would say, like AP7, which is a Swedish pension fund, Church of England pension fund, Westpath, a U.S. church-based pension fund.
Yeah. We had the University Pension Plan on talking about some of their work in this space in Canada.
They have University Pension Plan out of Canada. That's a great example. People have started being very public about this and writing, studies. And so all of a sudden, and I was at the PRI in person in Sao Paulo.
Oh yeah, how was that?
Last week.
Yeah.
And everyone was talking about system stewardship.
Really?
And so, but as I said, I think talking about it and understanding it does not solve these difficult prisoner's dilemma problems. And we need to build a culture of trust. And so what we're going to stop doing some of the work. We've been sort of individually advocating for certain issues because we just wanted to show as an example, this is how it can be done.
And doing some of those engagements with companies.
Yeah. Mostly we were not engaging with companies. We were working with shareholders and sort of showing them like how they can make these arguments, hoping that they would pick up the mantle, because we're not investors. We are
Gotcha.
credibility doing our own engagements. But we led sort of guardrail campaigns on antimicrobial resistant and paying a fair wage. And we did lots of other like individual resolutions to sort of show how it could be done. We're going to stop doing that work and turn to trying to develop some sort of platform or framework where investors can work together. And we always have to be careful about sort of antitrust law, especially in the U.S. environment these days. They have to be careful not, to do this in a way that conforms to the law, but build that trust to understand that everything in the financial industry and business world is not about grabbing the last dollar, that there's other ways to be successful as investors, as fiduciaries, and ultimately ways that everybody does better. And the pie grows and it's less and it's more resilient if we do this. And I think, for us, that's going to be There's going to be some work product involved. I don't know if it'll be like probably some combination of sort of white papers and a interactive website. But the key to us is really going to be, and we started this at PRI. We had our first event, bringing investors together and hearing what is it you would need in order to sort of change your, this alpha was focused on alpha, on individual company outperformance. What would you need? What are the tools? And hopefully by having them come together and talk about this and have us sort of develop tools alongside that trust can be built.
Mm-hmm.
And so that's kind of a project we've mapped out or are mapping out for the next 3 years.
And so it's kind of sounds like in part educational, in part helping people understand like how their peers are thinking about it and sort of getting over the barrier, like of that culture shift of like, this is a crazy new idea. I don't want to go do it alone kind of thing.
Yeah. And I think, the more people talk about it, the more it becomes normalized. And,
right.
And I want to say, it's like that old story about, the old fish swims by the young fish and says, "How's the water?" And the young fish turn to each other and they say, "What's water?" Like, it does not have to be this way. And I think a lot of people would say, if you went back, think of the US as a very, the center of this, profits overall and maximizing value universe. If you go back, 50 or 60 years and read the proxy statements or the annual reports of publicly traded companies, they would brag about how many employees they supported and how much taxes they paid. The water was not always like this, and it wasn't even always like this in modern times.
Yeah, not that long ago.
So I really do think that spending time having investors look at case studies and thinking about economics a little more deeply and understanding the danger of continuing on the path we're on does have a shot at changing the culture back to where it was 60 or 70 years ago. And I know life was not ideal 60 or 70 years ago, and there were other problems.
Yeah, it doesn't have to replicate it exactly, but
I think I don't think value maximization was the problem.
Right. Yeah, we went through such a dramatic culture shift, right, in sort of the 80s with Milton Friedman and Reagan and Thatcher and that whole sort of shift. And yeah, as you say, I think it's just been so baked in that people don't realize that, this is probably more the anomaly than what we're talking about here in terms of taking care of the social and environmental systems that all these businesses and investors and all of us rely on. That seems pretty straightforward, common sense. This episode is made possible by Metis Global Partners, a global equity solutions provider managing over $5 billion. Metis offers both active and customized beta strategies for institutional investors. Through their guided beta product suite, Metis provides custom passive equity solutions to clients desiring sustainably aligned equity and real asset portfolios combined with a high-touch partnership. Founded in 2013 in San Diego, California, Metis serves a wide range of institutional clients, including foundations, endowments, nonprofit, university, public plan, corporate, and family office clients. To learn more, visit www.metisgp.com. That's metisgp.com, or email info@metisgp.com. How about we talked a little bit about this, but in terms of shifting that culture and the role of business schools, do you know of any that are kind of adopting these? Any academics? You talked about Ellen Quigley over at Cambridge. We had her on the show as well, but any others that are tackling this that you know of, or what do you see as the role of business schools in all this?
So I'm not as plugged in as I could be to this, and this is part of our work, but I think like Caroline Flammer at Columbia, Dyer, a lot of thinking about system stewardship. I come out of a legal background, and so I'm familiar with some of the legal scholarship, like Madison Condon at VU has thought a lot about this. There was actually a conference called, every year there's a corporate law conference called the Burley Corporate Law something. It's named after this guy Burley, who sort of wrote the Modern Corporation book. He was in the Roosevelt era, and he sort of wrote about corporate law and got people thinking about what it meant to have publicly traded corporations dominate the economy. But anyway, they had a conference just a few weeks ago on corporate law and climate. And I was there, and there was a lot of interesting talk about system stewardship at that conference, and Madison helped to organize it. So I think that's another place you could see some scholarship.
Yeah, nice. Yeah, I mean, obviously we work with a lot of endowments and higher ed institutions, and we talk about it a lot in the context of just education and people going into leadership roles in any sector, whether it's government, community leadership, business, and having to understand this system's perspective. And I think obviously it's really central in this conversation. What about, you kind of mentioned coming back to the legal aspects of this and sort of the fiduciary duty considerations, because that's something that will always come up. And how do you see that? How do you have those conversations in terms of like board members who might be concerned about that?
So I can't provide anyone legal advice.
Spoken like a true lawyer.
But
the disclaimer.
So I'll go back to like I think it was 2021. The PRI and Generation Foundation commissioned a law firm, Freshfields, to do like a worldwide study on fiduciary duties, and I'm not sure they used the term systemic stewardship, but it was these ideas of universal ownership and what that study concluded, and they looked at like the 11 most important jurisdictions around the world for investment, was that it was consistent with your fiduciary duty. In fact, maybe mandated by your fiduciary duty to worry about these systemic issues and to worry about the impact individual companies might have on the broader portfolio. And in part, what I say is like, it's a great report, but it's not really that complicated of a legal analysis. It's really a factual argument, because the duty of trustees of pension plans or endowments, financially, is to optimize the returns. And there may be other, at a foundation or endowment, there may be other things, but like worst case, it's optimize your returns. That's the most financial,
most basic. Yeah.
And if you as a trustee conclude that, well, my returns are at risk from a warming climate or increasing inequality, and part of the problem is the practices of the companies I own, and I have tools to change those, it's just logic. It's not legal. It's just like a logical
Just need a rationale, right? And sort of write it down, say, this is how we came to this conclusion. Yeah.
And so, I mean, just so everyone understands, you asked me that question because there's been a lot of noise around whether system stewardship or whatever is consistent with fiduciary duty.
Right.
But when you actually look at that, and so-called red states, states where Republicans are in power, there's been a lot of even legislation or regulation around like the state pension funds and municipal pension funds in those states, whether they can, care about ESG. But when you get to this issue, the system stewardship issue, no one is really attacking that. Mostly what they're doing is just mischaracterizing what ESG is,
right,
or what people are doing. No one says, well, it would be a breach of fiduciary duty to try to increase the value of your portfolio by doing these things. It's more like, well, you're not really trying to do that. You're really just being woke or, trying to advance a certain political idea. And so for me, and again, not legal advice, but what makes sense is to just like get the facts in front of you, and as a trustee or as a fiduciary, and try to do the best you can based on those facts. I will note that there is this weird case, the Spence case, the American Airlines, that got decided recently. It's about a 401k plan where the judge says again and again, like, you can only do things if they're pecuniary, if you're trying to advance. And there's lots of, and it's all about voting. It's mostly about, how the BlackRock, which they used as a service provider and for a lot of index funds, how they voted. And it's like the factual approach of the court is kind of unusual. Like most of us wouldn't even agree with its characterization of the facts.
Mhm.
But really, most of what the court says is good, because you would take that and say, well, this means let's vote to make our portfolio valuable. There is some weird language in the case where he says, well, as a fiduciary, you would never want a company to vote or to vote to make the company less valuable. But he doesn't deal with this issue at all about, well, what if making the company less value makes your portfolio more valuable?
Right.
Um,
Right.
And there's actually one more interesting legal thing is just a couple of weeks ago, 4 young people in Canada
Yeah, I was going to
filed a
ask about this. Yeah.
against the biggest pension fund in Canada. It's basically like their Social Security, and said, you're ignoring all these climate risks, and in particular, you're ignoring the way some companies are going to impact our whole portfolio. So they actually brought this theory into their fiduciary complaint,
Mm-hmm.
raising the idea that not only is there like no fiduciary concern with doing this, there's a fiduciary concern with not
Right.
thinking about the impact your companies are having on the rest of your portfolio.
Yeah. What's your sort of take on that approach or strategy in terms of, the culture shift we were talking about? Do you think it at least kind of brings it into focus and gets people thinking, or?
I think it does. I will, first of all, I'll say that like we orchestrated a lawsuit against a single company on Meta a few years ago on this basis, and we don't have time to talk about all that. So I'm not one to say I don't like litigation, but I will say that I don't think we're going to get where we need to get on these sort of system stewardship issues by having courts order companies or fiduciaries to do certain things.
Mm-hmm.
But I think the utility of a lawsuit like the Canadian lawsuit is that what it's really saying is you're breaching your fiduciary duty by not considering this as an issue. If you just think company by company as a investment trust fiduciary, you're not doing everything you can. And
Mm-hmm.
what that ultimately means is you're giving the fiduciaries, the trustees, more discretion, not less.
Mm-hmm.
And I think if we think about it that way, that will help with the culture shift.
Yeah.
We want you to understand that there are more tools in your toolbox than you might have been aware.
Mm-hmm.
And I think that will help, trustees and CIOs and everybody who has to make lots of hard decisions more comfortable.
Yeah. Nice. Well, we're kind of coming up to the end, but I do want to quickly come back to the regulation piece, kind of what we were talking about earlier. And how do you see the role of that, like in this culture shift, as more investors sort of see this kind of bigger picture and how it benefits their whole portfolio? Do you see a role for them advocating for policy shift? Do you think that culture shift will eventually lead to better policies that do start addressing these externalities so we don't have to sort of worry about these conversations as much?
Yeah, absolutely. One of the important tools that investors can use would be to advocate for better regulation, to say, to the rule makers, our investments long term are at risk from antimicrobial resistance. So we would really benefit.
Yeah.
And we'll be able to pay our pensioners. And this is important, for you as legislators to make sure that people have comfortable retirements, to do something about overuse of antibiotics in the meat industry, for example. Mm-hmm. So I think there's definitely an important role for that. What I'll note is that there's no, what the economists call comparative advantage for investors in doing that. In other words, everybody who has an interest can go to the legislature, and that's good, and that's democracy. But investors should just remember that they have unique tools, because nobody else can vote for directors. Mm-hmm. Nobody else can vote for shareholder proposals.
Yeah.
Nobody else can allocate capital other than investors. So I wouldn't want them to forget about those tools where they have unique advantages.
Yeah.
And one thing I'll say that bridges the gap a little bit is one of the worst problems we have is that companies lobby against sensible regulation because they think they can make more money.
Yep.
So shareholders can use their unique tools of voting and engagement to push companies to not
do that
get in the way of sensible regulation.
Yeah, that makes sense. I guess I would also say, though, I think investors maybe do have a little bit of a unique approach when it comes to influencing policy because a lot of them have a lot of resources, influence, ability to go get access and have different conversations than maybe the average person does in Washington. Or so I think that shouldn't be underestimated either. But great. Well, Rick, there's so much more we could dive into. So hopefully we get you back and keep these conversations going. But I want to wrap up with some of our usual questions here. And the first is just a series of kind of quick ones and some personal ones. So what's your favorite thing to do outside of work when you're not thinking about these issues?
Well, favorite's hard, but I'll say I'm an improviser. I like to go on stage with my improv buddies and
Oh, nice.
be funny.
Yeah, that's awesome. That's cool. Where do you do that? Just improv studios?
I live in Western Massachusetts, where we are blessed to have the Happier Valley improv place.
Yeah.
It's unique for it's kind of a fairly rural area, but we have a big improv community.
Yeah, that's very cool. That's fun. One of my other favorite podcasts is Conan O'Brien's podcast, and he talks a lot about his roots in improv and a lot of comedians coming out of that. Nice. So how about back to work? What is your favorite thing about your work kind of day in and day out?
So, I'm lucky to have a job where I get to like think about like deep issues, and it's kind of I don't, and this is also sort of something that we're moving into where there's a lot of, in shareholder advocacy, there's just a lot of day-to-day blocking and tackling, and it's hard.
Mm-hmm.
And you don't always get a chance to think about the big picture. And the work we're doing now is allowing me to think about the big picture. And that's kind of something I've always enjoyed doing.
Yeah, nice. Very cool. All right. And if you could enact or change one policy or law to support all this work, what would that be?
I think I would clarify the antitrust laws.
Mm-hmm.
That's a boring answer, but that.
Yeah, when you mentioned that earlier, I was curious. Like, it seems like such a, I don't know, just a red herring to me. Like that.
Completely, and that's why I say clarify. I don't think like. I think if you sort of look at any logical way, I should be clear about this. If you look at any logical way about the purpose of the antitrust laws and sort of economic theory and consumer welfare standard, nothing anyone is doing in this field is a problem, but people are being directly threatened by state attorney generals. I think we're starting to hear noise even from the federal apparatus. And, whatever the logical outcome, the right outcome is, that scares people, and, just being investigated or called to account is very expensive, even if you're in the right. So that's why I say like some sort of clarifying activity that made it clear that it was not a problem.
Yeah. And for people who maybe don't know what we're talking about, like there's, investors that are working in collaboration to talk to each other to send consistent messages to companies around how they could improve around sustainability topics and things like that. Right. And it just.
Yes. And somehow people are saying, well, that's anti-competitive because you're asking companies not to compete on how little they can pay or how much child labor they can get into their supply chain.
Right.
That is absurd.
Yeah. Yeah. Nice. Awesome. Well, how about your vision for the future of finance? What do you think the financial system needs to look like?
I think we need, as I said earlier, to change the culture from one where everything isn't measured by financial success at the company level. And I think what that looks like is things like, okay, you might give an executive stock options in order to encourage her to, try to make the company more valuable. But there'll be clear parameters that say, but you don't earn this. And in fact, it'll be clawed back if the company violates certain sustainability, metrics. And the reason for the clawback is you want to make sure that the CapEx is locking in like a sustainable business model. So you don't want somebody to sort of make the stock price go up, sell all their shares, and then, walk away when the company then returns to its bad practices.
Right. Yeah.
And I think, private equity would sort of work the same way. You'd get your 20% carry if you met a financial hurdle, but there would be sustainability hurdles that you also had to meet. So like you wouldn't get that carry if you took a company private and then put in a lot of unsustainable, energy practices, for example.
Yeah. That's a great point. A whole nother conversation we do have to get you back on, because like aligning those personal incentives for the individuals that are making these decisions is as important as sort of the institutional incentives or the system, what's best for the system. And so I think that's totally out of line. And it leads to driving and incentivize these like really exploitive and extractive practices kind of at every step of the way. Yeah. Nice. All right. And how about advice for young people that might be interested in sustainability and business and finance and law? What advice would you have?
Kind of like a don't be discouraged. In the long run, like, there's that saying about the arc of the universe spins toward justice. Like I don't think there's any natural bent, but I think it's our job. I think, the David Graeber quote is something like the secret of the world, the hidden secret of the world is it's what we make it, not anything else. And that might not be the right quote, but this is like, if you're interested in pushing business towards sustainability, we're actually at, I think, a really good moment. I mean, we're at a bad moment in that I think business continues to be the problem. That like, it's not just like business isn't doing anything about climate. I think that the focus on profit at the individual company level is actually driving problems,
the whole issue.
But people are starting to recognize that. And so this is a good time to come in and think about how can I, be part of this stewardship movement.
Yeah. It's great way to end. And it is exciting. I mean, there's a whole new system to design and there's so much innovation, creativity, exciting new models to create. So, and you're doing a lot of that. So I really appreciate all the work you're doing. Thanks so much for taking the time to come on, talk about it a little bit here.
Thanks for having me.
Absolutely. And hopefully we'll see you again soon.
Okay. Thanks.
Take care, Rick. This episode has been brought to you by Metis Global Partners. Thanks for tuning in for the Future of Finance podcast. We hope you found today's conversation insightful and inspiring. Don't forget to subscribe or follow us on your favorite podcast platform. And please take a moment to rate, review, or share the show. All of this really helps us to reach more people like you who care about creating a thriving and sustainable future. And it's a really easy way to have a big impact. So please do follow. A quick disclaimer, the content of this podcast is for informational purposes only and does not constitute investment advice. Investments and strategies discussed may not be suitable for all listeners. Please consult a financial, legal, tax, or accounting professional before making any investment decisions. References to managers and funds are for informational purposes only and should not be considered endorsements or investment solicitations. This podcast does not monitor fund performance or guarantee the accuracy of third-party materials or statements. This has been an episode of the Future of Finance podcast, exploring how finance can shape a vibrant and sustainable future. Thanks for listening, and we'll see you next time.